My name is Francis Akawili, and I've been day trading for over 3 years. In fact, if you go to my Instagram and scroll all the way down, you'll see that some of my posts date back all the way to 2021. And since then, there's been a few people who have asked me how did they get started, or even just letting me know that they're interested in trading itself. And so I wanted to make this video as a guide for those who either don't know if they want to get into trading, or for those who decide to pursue trading. I would like to give them some form of actionable plan that they can go through in order to get started. Alright, so before I hop straight into the action plan, I did want to address one thing. And I feel as though that one thing will save you so much of your time, your energy, and your money. And that's the fact that you probably shouldn't trade. And I say that because most of you want to make money in the short term. You see all the social media, you think, wow, they're making millions of dollars from this thing or this endeavor that you can pursue at home. I want to get started too. And I don't blame you, because that's exactly how I started. But I did want to let you know that if your pure goal right now is just to make money in the short term, you should not get started, because the odds are stacked against you. And I feel as though trading is only an endeavor that you're probably going to actually be successful at if you're willing to stick through those odds, and if you're willing to go through insane difficulties for extended periods of time. So if that's something that turns you away from trading, but you still like to make money in the stock market or in the finance field, I suggest that you look more into long-term investing. And so long-term investing is when you buy something and let's say over the next 20 years it goes up, then you're looking to sell. But with trading, if you were to look at any long-term chart, you'll notice that even the US economy, it goes up and down, up and down, up and down, and it's just a trend of going up. And so if you want to trade, you're basically capitalizing on those very small micro trends. You're entering and exiting anywhere from a month to a few days, and even for some trading, a few seconds. So most people should get into investing, especially if you're trying to retire, which I hope most of you are. So I know that the main question for a lot of you is, how do you start trading? But the actual question you have to ask yourself is trading right for me? And the short answer is that you will never know. You'll never know until you actually start trading. It just so happened that trading was one of the side hustles that I started when I was 18, and I didn't like any of the other side hustles that I was doing. For example, you might get into trading because you think that the euphoria of entering a trade and seeing if it's going to make or seeing if it's going to lose money is exciting. But when you're actually trading, you might get really stressed over the fact that you don't know what's going to happen. And that's something that you won't know until you actually put your own money into the markets. So this, along with the many other lessons that you'll learn about trading and also yourself, is ultimately going to be the deciding factor to answer that question, is trading right for you? As I'm editing this video, I did want to throw in a quick disclaimer that for those of you who are already trading and you are simply looking for a profitable edge, this video likely is not the video for you. And that's only because I wanted to keep this a bit more beginner friendly. And so if that's your pure intentions, which is to just look for a strategy, I recommend checking out some of the resources that I listed below. And for those of you remaining who would still like to give trading a shot, let's get straight into the steps. The very first step is understanding what exactly is trading. So with trading, you're essentially trying to make money by either one, buying something low and then selling it at a higher price, or two, selling something at a high price and expecting to sell it at a low price. And this is one of the primary differences with investing, because with investing, you're a lot more likely to just be buying something and holding it for a longer duration of time, whereas with trading, if the market is going down, you can also make money. Let's say we have the price of Apple and it's going up on a very general uptrend. So if we buy it for $100 and then This is where we buy it. And then we sell it up here for $105. Then if we purchased one stock of Apple and then we sold it up here at 105, we make $5. And a really simple way to think about this is kind of like those people who scalp concert tickets. They usually are able to buy it for a lower price and then they sell it to other people for higher prices. You can also make money when the market is trending lower. And I'll go ahead and give a visualization of that right now. It's basically the opposite, where you sell something at a higher price, so let's say 105, and then you buy it back at a lower price, which means that you, again, pocket $5. So in order to better visualize how you sell something and then buy it back at a lower price is through an example with shoes. Let's say that your dad owns a pair of shoes. I know it looks like a D, it's a shoe, okay? This is you, ask your dad if you can borrow his shoes. So basically, you are now in possession of the shoes. At this point, with the shoes being worth $105, you are going to sell those shoes to your friend. So this is your friend. With those shoes being sold, you now have $105. And let's say, for example, those same pair of shoes, for some type of reason, it ended up dropping down to $100 in price. So, with that $105, you decide to buy back those same shoes from your friend. So you give $100 to your friend in exchange for the shoes. So the shoes now go back to you, and you now have an extra $5. And now you take those shoes and you give them back to your dad. So essentially, you made $5. What you're doing is you're borrowing something from someone else, you're selling that item to another person, and then you're buying it back at a lower price, and then you're giving that object back to the person that you borrowed. So that is how you basically make money when the price of something goes down. We are going to label the act of buying something at a low price with the expectation or hope of selling it at a higher price as going long. So this is known as a long position. And with the opposite, in the opposite case, when you are selling something and expecting to buy it back at a lower price in order to make profit, this is what's known as a short position. And this is what I'd say is the very first step of trading, because it's the foundation behind how you are expecting to make money. As for the second step of trading, you have to do some sort of research on what it is that you want to trade. I'll go ahead and make a list right here. But again, for the second step, you are going to be choosing and researching and then choosing one of the vehicles that you would like to trade with. Some of the options that you can start looking into are stocks. Another popular one are indices. And an index is basically just a basket of stocks. So I'm sure many of you have heard of the S&P 500, which is pretty much just an index, or it's like a big fund that tracks the top 500 publicly traded companies in the US. And so if you take that whole basket of stocks and you check out the price on a chart, that is basically what you're going to be trading, an index. And another popular vehicle for trading is Forex. That is you're basically trading the difference in price between two assets, or two currencies is what I mean to say. And those currencies can be the US dollar and the British pound. And there's so many different currencies. I've never traded Forex in my life, and so I'm not going to dive deep into that vehicle, but it is an option for those of you who would like to explore it. And another popular asset is cryptocurrency. Cryptocurrency has gained a lot of popular, and the cool thing about cryptocurrency is that unlike the other assets that I mentioned up here, crypto, the markets are open for 24 hours, 7 days a week. And so it's a very flexible option for those of you who want to be trading at more odd hours of the day. So that's something to look into. And another thing, which I found was pretty fascinating, was actually commodities. Now, commodities can be anything from precious metals like gold and silver, all the way to agriculture. If you think about it, people back then were traders. They would buy bunches of soybeans or corn and then sell it for higher prices, expecting the value to actually go up. And so you can trade those commodities as well. I'm gonna go ahead and list them. For example, gold, oil, and corn. And the cool thing with oil, this is a sidetrack, is that if you look at the charts of oil, you'll actually notice that when you go to the gas station, those prices will reflect in the charts. You want to pick one and stick with it, get to know it, get familiar with it, because that's ultimately how you're going to learn trading. Since if you were to switch between all of these different assets, you're probably not going to go very far because you want to become very specialized in one. And once you start to make profits and money in that one single thing, then you have the option to branch out into other markets. It's only if you know for sure that, okay, this isn't really something for me, then that's when I would recommend maneuvering to a different market. As for step 2A, the second thing that you want to choose is the duration of the time in which you want the trade to last. So, for example, there's an option such as swing trading, where you enter a position and then you hold it for anywhere from the next day all the way to a few months. A second type of trading is more traditional day trading. So you might enter it at, say, for example, 9 a.m. and then you exit at 11 a.m. And lastly, this type of trading takes place a lot more short-term based, which is known as scalping. And with scalping, you are entering an exit anywhere from a few seconds all the way up to a minute. So however you categorize the style of trading that you want to get into, the specific term doesn't really matter, but one thing that you do want to determine is how long you feel comfortable holding that trade. And my recommendation is to just pick one, learn about it, and attempt to get good at it. And if you find out that that style of trading isn't really for you, then that's when I would suggest pivoting away from it. For beginners, I recommend starting off with day trading. So that means holding a trade anywhere from a few minutes all the way up to a few hours. I feel as though that's a good medium because with scalping, you may find that entering and exit on a really quick basis may get a bit emotional because you're going to be going through a lot of whipsaws between getting into a position as well as exiting a position. And as for swing trading, from personal experience, I just found it really difficult to fall asleep at night knowing that my position was in the markets and I didn't really know what was going to happen. The third step is to open up a brokerage account. If you kind of remember this example where you had your dad, yourself, and then your friend, the person that you're borrowing the shoes from, your dad, is basically a broker. So your broker is the middleman behind how you're going to be making money from either entering long or entering short. Because if I told you right now to just buy 5 shares of Apple, you probably wouldn't really know what to do. However, by opening up a brokerage account, then you can simply tell the broker, hey, I have $500. I would like to
use that $500 and invest in 3 shares of Apple. And so the broker will buy 3 shares under your name, and that's how you will essentially own it. And if you don't know which brokerage account you would like to open, the only thing I can do is give recommendations for that of which I have already tried and which I have developed a good sort of relationship with. And so I'd recommend opening up a brokerage account under Schwab. Disclaimer, the type of or where you open your brokerage is also going to determine what type of the trading vehicles that you can actually pick. So if you wanted to trade Forex, I don't think that Schwab offers it. So that's something that you have to research for first. But if you don't know what to pick, like a trading vehicle, I'd recommend looking into stocks. Most people already have an understanding of stocks, a very general understanding. And so if you want to trade stocks, I'd recommend opening a brokerage account through Schwab, because it's just something that I really had no complaints with. And there's also a lot of other perks, which I'll get into in just a bit. And ideally, you want to open up a brokerage account which you feel comfortable having your money in. You're probably going to be keeping a lot of money in your brokerage account. For example, do you feel comfortable holding 100,000 to even $1 million in a brokerage that literally just opened last year? Most people would say probably not. And so I'd recommend choosing a reputable brokerage in order for you to feel comfortable holding your money in. For step number 4, you are going to want to open a charting platform. And a charting platform is basically just a software that you can use in order to track the price in real time of the asset that you are trading. One of the perks of Schwab is that they have a platform known as Thinkorswim, and this allows you to enter and exit trades through your brokerage account through Schwab, while at the same time using the same platform for your charting, meaning that you can also be looking at the charts while simultaneously buying and exiting all within the same platform. At this point in time, that's actually all that you need to trade. It might not be what you need to trade profitably over a long term, but if you simply want to find out for yourself if you like the act of trading, then this is technically all that you need. So when you fund your brokerage, I recommend only putting in an amount of money which you personally feel would not emotionally impact you. So for those of you who are kind of like in a similar stage to where I am, I'm in my early 20s, probably about like $500 isn't, it might hurt a bit to lose it, but it's not like you're going to risk putting food on the table, or you're not really going to risk most of your sanity over those $500. And so I'd recommend just picking an amount of money which you genuinely feel comfortable losing. So obviously, if it was that easy to simply open up a brokerage account, use a trading platform, and then trade, and then make money, then everyone would be doing it. But the main thing that makes trading hard are the series of steps that almost everyone has to go through in order to start making money on a consistent basis. And those series of steps that I just talked about, or that I will outline, can take an individual anywhere from 3/6 months all the way up to a few years. The main thing that you want to know right now is if trading is for you. So personally, what I did was I put in $1,000, and with no strategy whatsoever. I remember it was literally on like my 18th birthday. I bought random stocks and I held it anywhere from that day to a few minutes. And then I sold it. And simply from that point on, I realized that I did enjoy trading. I did like that little excitement of not knowing what is going to happen. However, just from placing one trade, you will be able to understand if you actually enjoy trading. Because if you find out that you don't like trading and you don't like the act of buying and selling something and staring at the chart for a few hours of the day, then guess what? You don't have to go through those same 3 months to 5 years of of the process of becoming a better trader. You might be interested in trading, try it out for a week, and then realize that it's not for you. All good. But I did just want to outline some expectations that I feel would be useful to you. Your profitable edge is the backbone behind how you make money over the long term. Now, if you take, for example, the casino, where all of the games are by statistics against the player, that is how the casino over the long term is going to make money. I'm sure you know that when you play slots, there are some people who do win money, but a vast majority end up losing their money. And so the primary profitable edge for the casino is knowing that although they might not win every single game, because the statistics are on their side, it is almost inevitable that over a long period of time, they will make money. In order to actually visualize what a profitable edge is in the market, I think it kind of makes sense to demonstrate it through everyday experiences. Now, let's say, for example, if you go out and you stay out late at night, it's more likely that your parents or your loved ones are going to worry about you. They might feel some sort of anxiety over whether you're out doing something that you shouldn't be doing, or they might be worried for your overall safety. And so let's say, for example, if you go out every weekend in the summer, by week 4, you might start noticing that every time you go out, you get a call anywhere from 10 p.m. to 11 p.m. And in that time, you realize that it is quite consistently your mom. And so you decide to take statistics on that, and you realize that your mom calls you 9 out of 10 times whenever you receive a call in that specified time period. And so, with that in mind, you are essentially taking a circumstance, and from that point on, you're able to base statistics or predictions of what is likely to happen. So, let's say that you get a call and all the criteria that you outlined before is met. You can turn to your friend and say, hey, if this is my mom calling, then I get $2 from you. And if it's not my mom calling, then I will give you $1. Then, as you can see, over a long period of time, that bet has a statistical edge in order for you to make money. And so a profitable edge is essentially where you outline a series of conditions that must take place in order for you to determine that there is a probability that some event will happen. Then you're able to start setting up a bet on those probabilities.
I did want to throw in a very quick explanation for why you need to set certain criteria and conditions that have to be met in order to form your profitable edge. And the reason why is because if we were to go back to the phone call example, if you receive a phone call at a random point in the day at a random time, that could easily be someone like your relative who is checking up on you, or it could be even a spam phone call. So going back to the market, if you were to place a random order, such as a buy order or a sell order, it's essentially a 50-50 bet that you're going to make money. In other words, a coin toss. And so when you actually set up certain criteria, it helps narrow down the probabilities of the next outcome. And the reason why profitable edges exist is because, going back to the phone call example, your mom likely called you because she acted out of emotion. She likely felt feelings of anxiety or angst when you were out. And so you'll realize that humans continuously make similar decisions based on the same emotions. And you're going to see that reflected in price in the markets. Everyone wants to make money, and so everyone is going to want to buy low and sell high. And so what you'll notice in the charts is that certain price movements tend to result in a specific outcome. So it's based on that premise that you are going to make money through placing bets on those probabilities.
And for some of the resources that you can use, which helped me develop my own profitable edge, I'll go ahead and start listing them right now. So on YouTube, you can look up resources such as TJR, Al Brooks, and Umar Ashraf. So these individuals have had some type of influence on how I ultimately developed my own profitable edge. You can probably research a really simple edge on YouTube, which you can literally get down in about 5 to 10 minutes. But ultimately, if you want something that's a bit more in depth, that will change how you see the markets, where you can then actually develop your own edge, then I'd recommend looking into the resources that I just listed. And I do believe that at some point I will come out with my own series detailing my actual edge, but for now, that's not really the focus of this video. I did just, again, want to outline the steps that you can take in order to start trading. And lastly, once you're actually researching your edge on YouTube or through books, you want to filter out which edge you are learning based on the type of style that you decide to do. So, for example, if you get into scalping, the strategies that you may choose, or the profitable edge that you actually may choose, can be really different compared to if you were, for example, swing trading, where you're going to be holding that trade for a few days. So just make sure that the edge that you choose, the edge that you learn, is in accordance to the style of trading that you actually want to eventually trade. Next step is to backtest and forward test your edge. So you might be wondering, what is backtesting and what is forward testing? Backtesting is simply just a way for you to determine if the edge that you've researched and that you'd like to implement is actually profitable. So what you do is you go through hundreds of trades in the past and you put your entries and exits and you determine if this trade was a loss or if it was a win or if the trade didn't make any money whatsoever. And you want to do that for multiple years, ideally, and through different market conditions before you have a big series of data that you can use to actually make some sort of refinement or simply just to prove that your edge is actually profitable. And the reason why this is so important is because there are inevitably going to be times where your edge appears to not really be working. And that might last anywhere from for a week to a month or even a few months. And the most important thing is that when you are trading with a statistical edge is you should not do anything that might change that edge, because it simply might just be one of those times where it's just not profitable. I mean, think about it. If you flip a coin 1,000 times, there's going to be an event that takes place where you're going to have 10 losses in a row. Now, does that mean that the probabilities are now skewed? No, it just means that it just so happened that you flipped it 10 times and it was heads, like 10 times in a row. Backtesting allows you to actually see how your strategy is likely to play out so that when you are actually trading it live, then you're not going to be surprised or you're not going to feel as much feelings of needing to change something that is already working, but just so happens to not really be profitable in that period of time. And in order to stress the importance of backtesting, I did want to dive a little bit into my story. So I personally have been trading with an edge. I don't even know if it's profitable, that's the thing. But I started trading with an edge in my first year of trading. And I'm not going to lie, there were periods of time which the edge really worked out. And I was able to even double my account in my first year of trading. But I inevitably encountered a losing period. And as soon as I encountered a losing period, the first thing that I did was research another edge. I hopped from strategy to strategy to strategy almost about 3 or 4 times because I just had no confidence in the fact of knowing whether or not it was actually profitable over a series of hundreds and thousands of trades. And because I didn't have that confidence, I ended up not even really sticking with one. You need to backtest because that is where the foundation of your overall belief and confidence in your strategy is going to come from. And what is forward testing, you might ask? Forward testing is when you essentially are showing up to the markets during the time at which the trade would actually play out, and instead of entering with your real capital, you are using a paper trading account. And a paper trading account is basically offered on most brokerages, and they just allow you to play with simulated funds so that you can actually calculate or see in real time if the trade was actually profitable. But you're essentially not even trading with real money, you're just trading with paper money. On step number 7, you want to be back testing when the market isn't open, and you want to be forward testing when the market is open, so that you can ultimately accumulate a sample size of at least 100 trades. And through that 100 trades, then you're able to gain a better sense of how does that edge that you are using, how does it perform through different market conditions, and whether or not it's something that aligns with how you want to be trading. So again, one of the reasons why I like Thinkorswim or Schwab is just because of how integrated everything is in that brokerage. It's really easy to just start backtesting. They have this feature called on demand. Go ahead and specify that. And that allows you to, if I wanted to, you're basically like a time traveler. You can skip back all the way to 2021 and watch how is price playing out at that exact time. And you can go ahead and rewind, you can fast forward. So it's just really flexible, and it's basically how I was able to accumulate hundreds of trades for my actual back testing, which I used last year to make sure that the strategy that I'm trading with is actually profitable. This step is probably going to take you at least a month. I mean, depending on how fast you're grinding through this, it can take you like a couple weeks, but overall I found it personally pretty mentally draining, and so I had to set aside a number of trades that I wanted to take or that I wanted to backtest. And then after that, then I just split that up into different chunks and different sessions. So that took me a little while. So I wouldn't expect this process to neither one be easy nor two be really quick. All right. After backtesting, this is when you form your risk management plan. Now, a risk management plan is essentially a plan that outlines what percentage of your overall capital that you're willing to risk per trade. So just because I fund my brokerage account with $1,000, it doesn't mean that I'm using that $1,000 to risk on a single trade. I mean, you can do that, but you're inevitably going to blow your account. But more often than not, what you do as a trader is you set aside a very small percentage of your account in order to risk per trade. And the reason why you want it to be, on average, pretty small is because, as you will know with backtesting, there will inevitably be times in which your strategy is going to go through losing periods. And so with risk management, it's quite literally in the name, you are managing your risk. So this is basically your defensive side of trading in order to protect yourself from the probabilities of going on a loss. Because no matter if you have a 99% win rate for your strategy, if you're risking everything and that 1% just so happens to take place, guess what? The whole thing comes crumbling down. So depending on your back testing, let's say that your strategy's win rate is like an 80%, where 80% of the time the trade ends up as a winner. If you think about it, because the odds are very high that you'll win, you can on average risk a little bit of a higher percentage. However, if let's say your strategy has a 20% win rate, however, every time you win, you win $100 and then you lose $1, then you will obviously need to risk a lot smaller of a percentage, because the odds that you go on an extended losing streak is a lot higher compared to the person with the 80% win rate strategy. So we're going to take very general advice and just say risk about 1 to 2% of overall capital in trading account. So the reason why risk management is really important is because when I back tested my edge, The most that I lost was about 6 trades in a row. And mind you, my strategy had about a 50% win rate. But when I was actually trading live, I ended up losing 14 trades in a row. And upon going back, all of those trades that I took were indeed actual legitimate trades. Like they weren't trades that I weren't supposed to take, they were trades that actually met my trading criteria. And so if I based my risk management simply on me losing 6 trades in a row from my backtesting, then I would have blown out everything come time when I actually lost 14 trades in a row on my actual account. And so it's a lot better to go safer and risk a smaller percentage of your capital, because at the end of the day, with trading, you're not really attempting to double, triple, or quadruple your account. You're really just trying to make steady, more consistent gains and compound your account. With trading, you don't want to think of it as turning $1,000 into $1,000,000. You want to think of it as trading with $500,000 and then making 20% on the account and then earning 100,000 from that 500,000. And that's the overall mindset that you want to be approaching trading with. And that pretty much wraps up step number 8. And for step number 9, you are going to be funding your live account. I say fund because I'm assuming that in step 5, when you were messing around with different trades, you probably lost your entire account. And so you're just going to be, again, refunding your account with new capital. And this capital is, again, I'm going to stress, an amount of money that you feel okay losing. So remember that at this point, you most likely will be trading with a profitable edge, but there's one more thing that you have to, I'm going to say, conquer or learn, and that's yourself. So this depends on person to person, but for most people, money is in general an emotional topic, and this will all be reflected in trading. And for those who have a very strong emotional attachment to money, they may find that even though they're trading with a profitable edge, which is bound to make money over the long term, it will be very difficult for them to actually do and actually act in accordance with the plan that they already outlined according to their strategy. So that's the reason why I recommend still trading at this point with an amount of money which you feel comfortable losing, because personally speaking, there were times where I lost everything as soon as I thought that I had everything figured out. So even when I was trading profitably, like that time where I doubled my account in my first year of trading, and after going through an inevitable losing period, I started to feel very emotional and I started to risk more than I intended, and I kept taking losing trades to the point where me doubling that account went back all the way to zero. At this point in time, you want to not only continue learning about your strategy and how it works, but you also want to continue learning about yourself. So the reason why it's important to reassess the strategy and yourself is because you might find out that it doesn't really work with your personality. For example, when you're actually trading the strategy live, you might find that there's new responsibilities in your life where you can't show up at the specific time that you initially wanted to. And so the strategy may no longer work, or it may no longer suit your personality. Like if the strategy requires you to be in a trade for about an hour and you realize that you can't stand being in a trade for more than an hour, then another type of strategy might fit and be better off for you. And so it's important to set a deadline, which is ideally about 3 to 6 months in the future. And that is when you're going to reassess yourself and your strategy, not just from a profitable perspective, not just in terms of like, oh, did I make money, but more so in the sense where you have to ask yourself, did you observe some certain things that might help you refine your strategy, or are there ways that you can adapt the strategy to yourself in order to better improve the odds that you follow through with your strategy? And so those are just variables that you kind of want to consider, but that you should only do after the few months. Because if you did them anytime before, those decisions are likely based off of emotions. And that's basically what I did when I decided to strategy hop. I'd never set a specific time in the future. I just simply said, this strategy seems to be losing. I'm just going to go ahead and change whatever I'm doing now. So when I refer to strategy, I'm talking about not only your profitable edge, but also your risk management plan. Like, for example, when I realized that I ended up going on a 14 trade losing streak when I only planned for like the 6 trade losing streak when I was backtesting, that's when I realized that, okay, this isn't working. I have to revise my risk management plan in order to better accommodate the unexpected events that might happen. At this point in time, you really should see yourself as a scientist. And I'm sure you guys have learned the scientific method where you put out a hypothesis, you test out the hypothesis, and then you form some sort of conclusion from there. And that's when you decide to either revise what you're doing or continue moving on because it might be progressing you towards your goals. So remember, the overarching goal of trading is to trade profitably over the long term. Not necessarily on a month to month basis, but through years to come. And so, whenever you set that deadline, a few months from now, you want to ask yourself, am I moving towards that level of profitability? Now, if you're making mistakes based on yourself and your risk management seems okay, and your technical edge seems okay, your profitable edge seems okay, then you have to look at yourself and think about the different ways that you can basically experiment with plans that you can put in mind so that you're better able to follow your plan. And for example, whenever I would take trades on my bed, because I would sleep with my phone on my bed, I realized that I would enter and exit trades really just based on emotion. And I would tend to forego my actual profitable edge. And so one thing that I had to do is make it a rule for myself to not trade in my bed. So that's just an example of what I mean by you're revising your strategy, and that strategy can also be with yourself, as well as your risk management and as well as your profitable edge. So I hope that made a bit more sense in regards to your goal being moving towards profitability, but you can't put this expectation on yourself where in 6 months, then I'm going to be profitable. The only thing you can do is set a point in time, like 6 months, and just assess, am I becoming more profitable? If the answer is yes, continue on. If the answer is no, then make revisions. And you're just going to be going through that continuous cycle over and over and over and over again until all three of those components of the strategy, such as your profitable edge, risk management, and yourself, until all three of those are leveled up, then that's when you're going to start finding some form of consistency and profitability in the market. Lastly, the 10th and final step is going to be reinvesting the profits or starting prop firms, which is currently what I'm doing at the moment. I'm not going to dive into prop firms. That's definitely more of an intermediate thing. And that is pretty much it. With prop firm route, very, very, very briefly, you're basically just taking outside capital and you're trading with their money. So instead of trading with only $500 and making a 10% return, $50, you can potentially trade with $50,000, and then when you make a 10% return, then you can make $5,000. So it's just a way to acquire more capital and overall start trading with higher amounts so that you can ultimately fund your brokerage account itself. And that is pretty much all the steps to trading. Step 9 is the hardest part. And I say that it's the hardest part because it's actually the part that you're going to be in for a while. And just because you move on to step 10, it doesn't mean that your approach to trading itself actually differs. You are going to want to continuously seek development in yourself, and you're always going to want to continue improving yourself. Because even if you are a master of yourself and you're able to trade profitably with an edge and you're following your risk management plan, if you're doing that and you're only risking $1,000 per trade, as soon as you might risk something like $5,000, all of a sudden your emotions will go out of check. Then you're not really going to be able to follow your plan because you can't stop thinking about the money and how much you're going to lose. And so that is when you're going to have to make improvements from that $1,000 mark to $1,500 to $2,000. So it's going to be a continuous process of leveling up yourself. So step 9 ultimately is the point in time in which you are going to stay in there pretty much indefinitely. It just so happens that step 10 is just an extra step if you want to continue scaling your account. And that wraps up the guide. In a very simple 10-step process, you can be on your way to making millions of dollars. But of course, you have to go through and put in the work. I myself am not making crazy amounts of money from trading, but I do believe that I have credibility when it comes to learning how to start trading. And so that's why I made this video in the first place. At this point in time, I am investing more of my own capital from outside sources, putting it into trading, as well as investing the profits that I make from trading so I can continuously keep scaling my account. And one final note is that trading is a long-term game. If it's something that you want to make money in the short term, I can guarantee you that you'll make more money working a part-time job than trading. Although the potential for trading is incredible, you also have to realize that it comes at a cost, and some of that cost is not knowing if you're going to get paid the day after or even if you're going to make money the next month. You have to treat and look at trading as a business. And I don't know if you've ever looked at some businesses before, but not all of them make money on a year-to-year basis. I believe even companies like Apple can have a losing product and they end up literally losing money for that year. So like maybe Apple isn't like the best example, but if you look up some other really big companies, you will know that they do have losing years. And that's how you have to treat the journey of trading itself, where it's at the end of the day a business. And with starting any business, you're not going to have someone who is breathing down your neck, making sure that you're waking up for trading on an everyday basis, making sure that you're not being dumb with your money and risking more than you should. At the end of the day, you are your own boss, and that has its own perks as well as its own cons. And those are just something that you're going to have to find out for yourself and ultimately see if trading is the right vehicle to wealth that you would like to pursue and that ultimately fits your needs and your desires. And for the very few of you who are left watching this video until the very end, I just wanted to sincerely thank you for giving me your time and attention. I understand that this might have been a bit of a longer guide, but if it can help at least one of you out there, then I know that I did a good job. And with that being said, I hope that you have a good rest of your day.